Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. Just looking here. Oh, okay. All right. Good morning, everybody. Let's, oh, you know, I don't have my restream chat up, so let's make sure I got that over here. So today, markets are closed. You can see I'm not even getting the futures data. So we should check up on Bitcoin first, shall we? Ooh, don't need to be that big. Okay, so we're still hovering just above 52. Not quite as high as the 53 that the futures are showing, but we're still on the higher end of that range. It's kind of interesting. We came up here, we had sell, there's a bit of a buy, and now I think that there's going to be another sell and it's going to go to here, but we shall see. Good morning, good morning. Okay, we got a couple of people on D-Live. Thank you guys for tuning in. Oh, need to refresh YouTube here, make sure I can see everything. Doubt we're going to have very many people today. Nope. Oh, not even hardly anybody on YouTube. I see on D-Live though, thank you guys. Okay, so we're going to do some NinjaTrader programming. Yeah, let's just make sure that I got everything all set here. Oh, that's funny. Okay. Well, since I don't see any discussion here, I'm just gonna go into looking at what I want. So hopefully I can open up new charts, because I know that the market is closed, but I should still be able to see stuff, right? I don't need tick replay probably. Okay, cool. Well, it does load a 5-minute chart for me. Pretty good. All right. So I was wondering, and I have a correlation strategy. I don't. Okay. So let's do some searching around here. Oh, let's just leave that like that and we'll find it over here. I'm thinking there's a lizard indicator that we could use. I think we want statistical analysis. Z-score, moving median regression. Oh, he doesn't have one. Okay. We might have to make our own correlation indicator. That would suck. Ninja Trader. Where's the search bit here? I know there's a search somewhere. Ah, here it is. Search. That's an old one. That's the Ninja Trader 7 one. All these are really old. I don't think there's a really good Ninja Trader 8 correlation indicator out there, guys. Let's just search Google. Okay, here's a thread. Oh my. Okay, so we might be converting something today. Does anyone have correlation indicators? Wow. I bet you there's... Wow. Well, dang, guys. I think we're making our own correlation indicator today. That might be a bit of work, but let's see. The user app share. And it doesn't take me to it. This guy linked to a Ninja Trader 7.1, but am I spelling this right? Yeah, I am. Nope. Oh. Oh, that is okay. I was reading something else about Elder Impulse, and that was John. John mentioned me on the Futures IO forum. Okay, so what we're gonna do then is we're gonna search correlation and ATG pairs, I think, is the one we want. Okay. How you guys doing over here? I see you lurking. Okay, so did it go to pictures? Yep. Okay. Indicator. I don't know if I want Visual Studio to open. Oh well. Okay. Initialize. They're adding a plot. A couple of just pictures. DS input 1, input 2, log returns. On bar update. Be reciprocal is true. If it is, closes 0, 0. If it's not, closes 0, 0. Well, that line does not make any sense at all. Because he's doing the same thing regardless of whether it's true or not. Okay. That's weird. Weird. DS inputs 1, then the data series named in the second instrument property is used in correlation. Construct the spread to be used in the correlation. Now DS input 1 hold price different between leg 1 and leg 2. Calculate the natural log returns for the two correlation inputs. Run the correlation calculation and plot. Okay, so this plots the correlated logarithmic returns of two data series. So is that quite what we want? I think we need to do a little bit of research about correlation treating. I think the Investopedia is probably what we want. Correlation between two instruments, yeah. Perfect correlation is 1. No correlation is 0. Determining correlation. You measure this using a correlation coefficient, which reflects, yes, they explained that already, but how are they calculating that? And use its correl function to perform the calculations as shown in the following figure. The results can be used as a filter to find. Okay. Okay, that's not too helpful. The calculation for correlation coefficient is rather complicated. Awesome. You guys excited? Because I'm getting a little like, oh no, I hope I'm not jumping in over my head. It's going to be a super complicated calculation. Okay. I want to do something that we'll be able to finish before the end of today. But if there's not really a good correlation indicator out there, we got to do it. Like we got to do it. Because I want to be able to see, like, okay, I stick all of these things on the chart. Which one is the most correlated right now? Or which one is the correlation increasing on? And then based on that, you change strategies. That's kind of what I want to do. So we got to make one. Since it appears that there's not a good one out there. period's price squared with the average at the bottom. The last column show and multiplied by QQQ for each period with an average at the bottom. Okay, so here is Intel's prices, and here's QQQ's prices, and here's Intel's price squared and QQQ's price squared. Okay. And then they have some calculations. Variance of INTC is the, so it's the average of these, right? The last columns using the bottom row. Wait, where did it say? Oh, with an average at the bottom. Okay, so it's a 20-day rolling average. We calculate these things, and then the variance of this is the average minus, what is that, 22? Okay, so it is Intel squared minus the average squared. Oh, I see. So you're taking the average of the Intel squared from all of these ones, and then you're taking just the average price squared. And that is the variance of that one. And then this is the variance of that one. And then the covariance between the two is, okay, the average of the two times together minus the Intel one times the QQQ one is the covariance, and then the correlation coefficient is the covariance divided by the square root of the variance of Intel versus minus the variance of, okay. So what this one is doing is totally different. So I don't think that this one right here is what we want at all. Let's make sure. Okay, I got you. Just wanted to make sure that I wasn't missing the YouTube comments. You guys with me here? Okay. So let's close this since we're not going to need that. We're just going to create this from scratch. And we're going to say, well, new Ninja script editor for starters. Okay. Indicators. I can't believe that there's not one built in. Can't believe that. Is it like called something else and I'm just missing it? No, I don't see it. Well, we might be writing something that we don't need to write, but I'm not finding it. So we're going to do it. All right. Okay. New indicator. Next, and we're going to call it correlation. The correlation, what do we call it? The correlation coefficient. How do you spell that? Good grief. All right, let's move this a little bit over. Oops. Like that, yes. The correlation oh, I was going to spell it right. I was always really bad at spelling. Like, spelling was my worst subject in school. Between two instruments. Well, let's just say between two data series. Okay. Okay, calculate on bar close. Yes. No, actually. Yeah, I think it's going to have to be on bar close. And then primary, no, I don't know about. Optionally select additional data for your custom indicator. Oh, does this do it? Oh, that's a custom series. No, I think that we just want to add a new one, but we're going to have to, okay, we're going to have to write that part from scratch because it's going to make something that's not helpful. I've done this before, but I'm going to have to, pull up some code from another indicator to do. So, okay, market events. Nope, we don't need any of those. Input parameters, period. And we'll make the default 20. Okay. Awesome. Okay, so now we got period. Okay. Save that. So now I need to look at my spread indicator here. All right. Yes. Okay. Was that in configure? That was in configure. I don't know if configure is the right spot for that, but it'll work. And we're going to call this compare. So I'll have them primary and compare. Yeah. Getting to burps. On bar update, blah, 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 blah. No. This right here. Yes. Okay. In the properties, period. Name. Compare. String. Compare. Okay. Let's just save that. And I have my chart here. And indicators. Oh, I have to build it. I have to build it. Oh, they changed the picture. They changed the picture. Okay. Correlation. Bada boom. Okay, but it doesn't do anything. Okay. Okay, and now I also think I need some plots here, right? Oh, how do we do that? Oh, yes, that's right. We'll do it like this. Okay, so we're gonna need like 5 of these, aren't we? We could have done these in the properties, like when we were setting up going through the wizard. We could have set these up in the wizard, but I didn't quite know what we wanted yet. So 2, 3, 4, 5. Okay. So this one is going to be primary squared which is going to give us the values of 1. Oh, I guess there's actually 6. Because we need this one, which is a correlation coefficient. Correlation coefficient. That one is 0. Okay. Primary squared. Compare squared. I think I made more than I need. Well, let's see. Maybe I'm wrong. Compare squared. Primary x compare. Right. And then you get the average of that one. The average of that one. Okay, so I'm not sure that I need these ones. Okay. Correlation primary. Blah, 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 blah. Oh, yes. Okay. 1, 2, 3. And I need to add the plot here. I think that I actually have to add all of them. Correlation coefficient, coefficient. Okay, and then this is primary squared, compare squared, primary x compare. Save, compile. F5. Okay. So each time we go in and we say primary squared of 0 equals close of 0 times close of 0. Compare squared equals how do I do this? I forget. I can look at my squared. It's going to be bars array. Yes. So I shouldn't use close here. I should say bars array of 0, 0, like that. And then then this one is going to be ones. Okay, let's see if it does it. So I'm gonna need to probably oh no wait, we're good. ZB 0619. What we're comparing against. All right. So I'm getting two data series. It's hard for me to calculate if that's what it is, but it's if I just spitball it here, 123 times 123 is 15,129. Okay. So I think we're good. I'm wondering, I don't think it should matter. We'll see. We'll see. I think that the correlation thing should adjust for the fact that this one is only changing a teeny tiny bit and this one is changing like a ton. That's why it does it the way that it does. Okay. Because you're comparing the change in the average to the change in the... Oh, the way they calculate this is very interesting. Okay. And then primary cross compare of 0 equals, and it's going to be this same thing, except for that this time it's going to be, this one is going to be 0. Sometimes this one. Okay. Cool. With me so far, folks? I didn't think I skipped anything. So just to review what we did here, the way I started out was first I figured out all of the properties that I needed. So we had the period, a string for the compare, the instrument that we're going to compare against, then a bunch of series for the things that we need to like keep track of, and then you have to add plots for the series to work. And here I added the data series to pull in the other instrument that we're going to have. Actually, let's add in here. You know, we'll add another one in. ZB. Okay. So ZB is 146, and if we do 146 squared, it's around 21. Okay, so yes, it is pulling it in correctly. Cool beans. All right, so now the next thing is the variance of the primary variance is the average. Okay, so okay, so then we say average of primary squared equals SMA primary, or actually we'll just do bars array of 0, comma, and we already have period, right? That's what I called it, right? Period. Yep. Okay, cool. average of compare squared equals SMA bars array 0 or 1 and then I also need to do average of primary x compare equals SMA of primary x compare. Oh, you know what? I'm doing this wrong. This one is, oh no, wait, primary average of primary squared is the prime. That's the average of the primary. So that's that, and that's that. I'll do it. Okay. 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 So now I've got 1, 2, 3, 4, 5. 1, 2, 3, 4, 5. Okay. So now I got all of the averages. And then we say the primary variance equals, and then what was it? It was the scroll down here. Hey, good morning, live action. Thanks for tuning in. So we're making a comparison indicator based off of this lovely formula that is on stockcharts.com. Since apparently one doesn't exist for NinjaTrader 8. So, okay, so primary variance is the average primary squared minus average primary times average primary. Like that. Put the brackets around it just to make sure that it does order of operations correctly. Correct? Compare variance equals average compare squared minus average compare times average compare. I love that primary and compare are the same number of letters, so the code is all neat. Okay. Covariance equals the average of primary x compare minus average primary times average compare. Right? Let's see here. 22. Yes. Okay. And then bars, or no, sorry. And then what did we call it again? Oh, just correlation coefficient of 0 equals, and then what was it? It was the covariance divided by square root of the variance, primary variance times compare variance. Yeah. We're just double checking all my work here. If this like compiles and works correctly the first time, I'll be super. Oh, duh. Of course. Of course. Cannot implicitly convert type SMA to double. Yes, because we need to do 0, because this returns a series. Right? This SMA method returns a series, and we want to get the current value of that series. Silly mistakes I make. Okay. Oh. AVG. That was a funny mistake. Okay. Okay. Oh, did not like something. The calculation results in unrenderable values. Oh, really? Oh, really? Okay, so let's add an output window here. Oh, where did it go? I just made one, it didn't make it. That's retarded. What's wrong with you, Ninja Trader? It won't let me create a oh, here it is. Here it is. Okay. It was always there. So I'm probably making a mistake in our calculation somewhere in here. So let's see if we can get it to print. Okay. Error on calling calculate min-max method on bar 1101. The calculation results in unrenderable values. interesting that it's the values that it's spitting out to me don't look right to me. See those two charts? No, what are you talking about? This should be like close to 1 all the time. And it's not. So where did we screw up? Average primary, average primary 1 0. Oh. No. Oh, that's right. See those two charts, horizontal layout? Are you talking about this on my screen, this one and this one? Should have the pen on. You mean this? Or what are you talking about? Yeah. This was shown to me by 2 Arby's oil traders. Okay. Okay. Yeah. Keep typing. I'm gonna try and figure out what's wrong with my calculation here. RBS. Okay. So we know that these were right because we checked them and it was printing them, frankly. These SMAs might be wrong. This does return a series of doubles, right? Yeah. Primary X compare. Period. I think that these are all correct. Primary variance, average primary squared minus average primary. Average compare. Read so it covariance equals man. So covariance divided by the square root of the primary variance times the comparison variance. Layering a 30-minute over a 5-minute this way rids the noise and overlaying profiles quickly. You see consolidation slash value laying the chart this way. You don't need profiles. Oh, okay. It's a little different from what we're trying to do, though, of course. How does that result in unrenderable values? Just because it's such a long thing. Let's search and see if anybody's ever run into this. Bum, 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 ba-dum. Does the indicator throwing the error override on calc? Generally, the best way is to reduce the code used by temporarily commenting parts out, then reapply the indicator to see where if the error persists. Well, so I'm pretty sure that if I commented out these two lines here, and refreshed, that it would be fine. It is. Oh, I need another. Okay, close bracket. Four, five, six, seven, six. Okay. Not a number. Okay, so this. Oh. Wait. So it's the primary variance times the comparison variance. One of those is a negative number? It didn't print that out at all. That's weird. Huh. Wait, now I'm confused. Is it because the first one is not a number? Aha. Okay. So the solution to this is, what is it called? We have to add it up here. That's like a minimum bars to plot or something like that. Let's look at SMA. I think that there's one in SMA. Bars required to plot. Is that what it is? Yes. Okay. So it's bars required to plot. Now that can't be. It's not auto-filling it for some reason. Period. The first two are 0. That's interesting. Let's say bars to required to plot is 3 instead. I'm gonna clear this out. Does that get rid of our... No, it still does them. Oh, but it probably... let's see what it does. I don't need that line anymore because I'm printing it out before it. Yep, it does. So if what happens? Do we just not put one in there? So here we can say like if primary variance is greater than 0 and, well, let's just say if primary variance times compare variance is greater than 0, then we do it. And if we don't, then it's just not going to put a value in, I guess. Well, let's just say else correlation coefficient of 0 equals 0. Let's just say that. That should get rid of our error at least. Yes, it does. All right. If you watch the migrations from value, you will see reasonable targets of initially fractal balance. This happens constantly. Okay, we'll just do that when if we could finish up with this, yeah? Okay. So now we need to change these to brushes dot transparent because we don't need to see them anymore. And then I have to remove the remove it and then add it back in because it's keeping the ones from before. It's keeping the colors from before. So if I re-add it back in, that should get rid of them and I should only see the one. Bada boom. Well, that's not right. Is it? Is it right? That it gives me not a number a few times. Wait, what the fuck? Some of these are not okay. How is that how is that 26? What the fuck? Wait. Is that really doing that? Oh no. No, it's not. Okay. Now wait a second. That's not, something else seems not right to me because well, I mean, that makes sense for that instrument. But now if I change it to like ES, it should not be 1. Okay, so let's try it. ES. Oh. Oh. No, that can't be, that's not right either. So where am I screwing up in my calculations, folks? let's remove this one. And add the ES. Now, we don't want tick replay. That makes things take forever. Okay. Well, that's not right. Covariance divided by... So over here in this, those numbers should never be negative, should they? Well, no, this could be negative. Alongside the long formula. So I think what's happening is it's showing me negative correlation and okay, let's try this a different way. Incorporating your order flow evaluations at key areas in the order book with this is a good combination. Yeah, you're saying you do something like this, but have one be a 5-minute and one be a 30-minute, and yeah. Okay. Anyways, so I'm gonna try doing this a slightly different way, and say, because it's what's happening is one of these two numbers is negative. One of these two numbers is negative, like it's running underneath of the average of the squared or whatever, and so it's giving me an imaginary number. Okay. I noticed a number of times you were taking profits for entering. Well, I think especially yesterday I was crazy. So what's happened is we've moved from a trending market to a more range-bound market. And so what's happening is I'm seeing like a fall through. Like, how can I show this? Okay, so let's zoom in here on this, right? So like, I would really have to do this one. Okay, so like here, so like I would see something like this here. We came up and we came into this area and it was choppy, and then I saw there was a lot of order flow and it looked like there was some icebergs and that they had pushed through them. And so I tried to sell it as she goes, because that's been a reasonable trade as of late, and it's not anymore. Okay. But I think if I understand what you're saying come in here, add a ZN again, but change this one to be a 30-minute, and this one, it can be like a 1-minute chart, and apply that, and you get something like that, right? That's what you're talking about, right? Laying a 30-minute over, a 5-minute this way rids the noise and overlaying profiles quickly. You can see consolidation slash. Well, order flow can fake you out in so many ways. Yeah. I mean, that's the whole. I think that's really the whole way that they do this is they say, why did my correlation change? Oh, that's so fucking weird. Okay. The way that it works is there's seasons, and during seasons they'll use different strategies. So in one season, they will wait for everybody to lean against them, and then they'll bust through them with market orders. And they tend to do this in trending markets because they know that in a trending market that they're not going to get fills on the limits. But then when it's not doing that, they sit there with their limit orders and they wait for, they pretend like it's the thing before. They put the pressure on the other way. They force everybody to sell into them. And then just as it looks like it's like fallen through and there's been a trend change or whatever, they're filled and then they let it move back up. So if you're trying to do the one when it's a different time period, then it doesn't work. Yeah, trending market pump and dumps. Yeah. So, but man, I tell you what, I woke up this morning. I was so sore. I'm getting like the DOMs like crazy. And I just looked at some of my actions yesterday. I think that it was common for me to fade that move at a certain point. That when it come back to break even or whatever, I would see if there was a thing. And this one right here, where was it? This kind of thing right here, I would normally take that, and then it come back up here to even. I would get out and I would lose. Okay, -2. So for sure. And then maybe would I buy after that? I don't know. But the opportunity was kind of lost after that, wasn't it? There was a short that I saw and I missed, but like I tried to get filled on this one and then it didn't go. And then I didn't have any more time left. But then when I look at the trades that I actually took, and it was like, I took some that I shouldn't have done. I took some signals that were bad signals, and I lost more on them than I should have lost. So I think that I was, my nervous system was a little bit stressed out from my workout, and I made poor execution because of it. That's what I think. But it's also is going to be the case now and for a long time. I think that I tend to get faked out in that range bound action. I've found some ways to kind of get around it, but we've been so trending lately that I have to retrain myself. You know what I mean? Anyways, because it's totally true. Like the whole thing, the order flow, it's a big meta game. It's a giant meta game. People seem to think that you can take the same signal all the time. You can't. You have to know the context that we're in to know which one you should take. You're a bright person. You get this in short order. Not like most. An old hedge fund owner told me it takes 6 years on average to trade well. Wow, 6 years. That's interesting. I feel like that. Well, I've been doing it for about 3. And I can see why it takes 3 years to get to the point that I am. Because you can read order flow and you can see the signals. And I think that a lot of people see them and get it within 3 to 6 months. But the problem is that when you get to that point, you've only seen one kind of market. And I think that when you've seen the yearly cycle 3 times, that's enough data for your brain to start putting together the pieces and seeing, when the switches are. But if you've been in for less than a year or 2 years, you might not know the context enough. And so you probably still make some big mistakes. I don't understand why when I changed that my correlation changed. Is it because I'm putting on a secondary data series and that's screwing up my indicator? I don't know. I didn't recompile that, right? No, see, I haven't saved and recompiled that. So I don't understand why. So it should be 0 there a lot for the beginning. Yeah, but see how it never goes negative? It never goes negative. So I think that to do this calculation correctly, I think that the stockcharts.com is where did that go? Okay, let's get rid of some of these windows. We don't need that. It's because it's giving us an imaginary number. Okay, so in this example that they gave us, these are negative. These are never negative. But one of these is going to be negative. The variance of one of these is going to be negative, rather. And when it's negative, then that gives that square root function is an imaginary number. So let's just see. So if we search for correlation coefficient, strength of the relationship between the movement of two variables. So this one is a little bit different. They just show, they're saying, okay. Measure of the strength of the direction of linear between two variables that is defined as the covariance of the variables divided by the product of their standard deviations. This is the best known and most commonly used type of correlation coefficient. When the term correlation coefficient is used without further qualification, it usually refers to the Pearson product moment correlation coefficient. See, I don't think that this calculation that this other page is giving us is correct, because it's given me values way beyond 1, and it should never get beyond 1. So how is that happening? Let's put some additional prints in here to see. I'll do print -n, print primary variance, print compare variance, and compile that. I know guys doing this 20 years and still don't get it. Wow. Well, I appreciate the compliment. Yeah, see, it's still giving me some weird stuff. Okay, so like that one right there, it's like 96. So how is that primary variance doing that? Primary squared. Okay, so let's just try like primary, average primary, and average primary squared. Save. Yeah, I think the thing that's unique or weird about me is that I don't have a very high degree of agreeableness. And I'm ADHD. So when you're ADHD, you realize very quickly that you tend to forget things or you see things that aren't there. Make a little mistakes that other people don't. And so you don't trust yourself as much. And I think that that's why I take the trading the way that I do, is like, I know that I'm going to see something that other people don't. And a lot of the time it's not going to work or it's not going to make sense. And I think that kind of puts a little bit of humility in you. Or, like just the thing of questioning yourself, which is necessary to trade. So, I don't know. We'll see. The problem that I have is like I do so well in like the good period when my strategy works, and then the rest of the time I'm trying to get to work the rest of the time, and it just doesn't work. And hopefully this year we get over that. Yesterday was a little bit of a wake-up call because it was a place where falling in those traps really, really hurt me, right? Okay. Okay, see, so that's not right. Because the average primary is 123.11 blah 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 blah. And when I do this, 123.11875 squared is 158.22. Is it not doing order of operations correctly? Because then, the covariance. What did I have before? Was I showing variance? Yeah, I was. There's definitely something wrong with this calculation. You like Levin's take on the Mueller this morning talking about unagreeableness? Okay, I'll have to take a listen to that. Okay. So see, that's not right. That's not right at all. So this first one is primary squared. And this second one is the primary times the primary. And when you take the difference between them, it should be like a super small number. Oh, is it a super small number? I guess maybe it is a super small number. Because it's giving me a little E05. I think that means that it's incredibly small. Is it that I need to be using floats? Let's see here. C# double versus float. Float and double are floating binary point types. In other words, they represent a number. A binary number and the location of the binary point are both encoded within the value. For numbers that are naturally exact decimals, it is good to use decimals. For numbers which are artifacts of number nature and which cannot be measured exactly anyway, float / double are more important. Float is 7 digits, double is 15 to 64. So it seems like a double is the right. You can have up to 7. For doubles, you can have up to 16 digits. But it might matter more for decimal. Okay, but let's just come back to here. So I think that is actually, when it gives me the E05, that means that it is a really, really small number. ipconfig, what are you saying about that? Okay, so let's try that and see what it does. Move this up here. Okay, so that's wrong. So when I take the compare times compare, yeah, I did that right. Average compare squared. And the difference between the two of them is 1,000? No, that can't be right. Oops, whoa, that's crazy. I didn't know that the calculator could go full screen. 8472025 minus 8470282. Wait, what? Did I click something weird? 8472025 minus. Oh, that's like a really huge effing number. 8, 4, 7, 0, 2, 8, 2 equals 1,743. Okay. Seth, roll your charts back this weekend and try this approach near the cash open. You will see yourself making good calls nearly every time. So now, well, was I understanding what you were saying though? Was just you're saying, I have a 1 minute and a 30 minute, and then what was the second part of it? And then you're saying you don't really need the profiles, just watch it migrate from different value areas. Yeah. I don't know. We'll see. Why is it such a big... It shouldn't ever be that big of a number, right? Okay. It's weird that... So the compare variance ends up being really huge. And this one ends up being really small. When you compare them, they might end up being a negative value, yeah. I don't... That's super weird. But I think that they're giving us like a way of calculating it that's probably not really the right way to do it. So let's go back to Wikipedia here. Pearson coefficient is known as a measure of the strength and direction of the linear. Okay, sounds like it's defined as the covariance of the variables divided by the product of their standard deviations. Sounds correct to me. The covariance of xy divided by the standard deviation of xy. The co-formula for P can be expressed in terms of mean and expectation, where x is the mean of x minus ux is the mean of x. And E is the expectation. Did I pick, was I reading something in here wrong? 496. So the variance, primary variance, equals the average of the primary squared minus the average of the primary times the average of the primary. Yeah. Compare squared, compare. And then the covariance is, man, hold on a second. I mean, it seems like this should be working, but it's like I don't understand why it's giving me such a big number. And even then, it's this thing right here. One of these ends up being negative, then you get a negative value, and you're trying to do the square root of them. It doesn't work out. Anyways. So when I'm reading this, there's a couple of parts that don't quite fit those. So like, what is the expectation? In probability, the expected value of a random value is the long run average value. Covariance. Covariance definition. Between two jointly distributed real random values x and y with finite second moments is defined as the expected product of their deviations from their individual expected results, where e equals x is the expected value of x, also known as the mean of x. Aha. X minus the mean of x times y minus the mean of y. Sure. The mean of all the second coordinates of the data y. Calculate s of x, the standard deviation of all of these. Okay. So let's try starting this over, yeah? So we need these. And then we also need double deviation primary, which equals standard deviation of bars array of 0 over the period. Okay, so calculate the mean, standard deviation of this one, the standard deviation of this one. Use the formula xi, the standard deviation minus the mean divided by, wait, what is xi? Oh, geez, really? Then I calculate for each one what the difference between those two are. Multiply the corresponding standardized values. Add the products from the last step together. Divide the sum from the previous step by n minus 1, where n is the total number of points in our data set. Gotcha. Randy says, I focus on the DOM, so I always have a 30-minute and 5-minute on my other chart. Well, I always have that 30-minute thing. You know, like when I look at yesterday, I look at it as like, okay, overnight action. Well, news, overnight action. Okay, news event right here. News event came down and up. So that's how I look at that. Is there was a push, and that move was retraced, which means that move is now like doesn't matter, right? So now we're here, and then we had to move this way, and it came back, and it matters. So the way that I look at it is that we had a piece of news. It really moved the market. But ultimately it didn't change people's perception of value, right? So the place that where I tend to screw up is that I tend to say, you know, if we're moving up, I only want to go long. And if we're moving down, I only want to go down. But how do you know that it's not going to do this, right? Well, if it's a trending day, then we assume that it is. And if it's a range-bound day, then we assume that it's not. Although usually it would be more smaller, you know? That's basically the way that I do it. And so yesterday, I missed this. I really should have taken a trade in there. Things would have been very, very different. This right here, the assumption is that it's going to do this. But it's wrong, and then it's wrong. Okay, you got 2 wrong in a row. Then you should catch this one. But that's not what happened. I screwed up again, and I took it along somewhere in here. Anyways, so that's kind of the way that it works, why I get screwed up. Okay. A simple, stupid trick. Look to find hold for a trend day when price is above or below yesterday's higher low. That one's a little, yeah. So here's another thing. Just on profiles. So like, I don't know if we have a really good example. The thing is if you come out, okay, so like here today, we were like pretty much open to where the previous day closed. Do you see that? This area right here. So when that happens, you got 2 things. One is it could move back up to previous value, and it's a range bound day, or you're going to get a trend day down, which is what we got, right? But it tends to go back into the previous day's value more often. And especially, so like here, like this, okay, we closed, you know, we opened pretty close to where we were, right? But then we went back to the previous day's value area, and then they actually tried pushing beyond that got rejected, and then we moved higher, you know? So generally speaking, when I come into that situation, I'm looking for an indication in the order flow about which one is going to do. So if it'll start out slow, and the assumption is that it's going to revert, it's going to test the previous day's value area. But if you don't see that and it kind of just really slow, quietly moves up, then that's an indication that they're going for the trend day. And if you get in early, you'll find out that they really start ramping up, and all of a sudden it's like moving up like crazy. Okay, 30 minutes. Calculate a standardized value for each xi. This is the mean, and this is, what is the S of Sx again? Is a standard deviation. So, this right here, this zx equals bars array 0, 0 minus average primary divided by deviation primary. Right? And this one should be 1 average of compare, deviation of compare, multiply corresponding standardized values, zx, zy. Okay. What about a way to incorporate options volume and spread volume? They both have a huge impact. This is why I question volume sometimes, because outrights are only a portion. It's a good question. Smash the bit. I mean, like, here's the thing: is that the volume that we see can give us a good idea of like the imbalance in the current futures, and if people are gonna, if there's gonna be future buying and selling within like the next minute. But in terms of it giving us a good idea of, are we going to move up overall today? Is it going to be an up day or a down day? When you look at the whole day, it doesn't really tell us that. And we would have to look at other things to be able to do that. We would have to look at the options volume, and we would have to look at the cash market. I think that's why order flow really works the best in the 10-year. So when you do it in ZB, it doesn't work the same way. But that's kind of why I'm trying to do what I'm doing here, is that I want to see, okay, instead of looking at all of the different components of the treasuries themselves, I want to look at the things that will affect the treasuries. So I know that if the currencies are moving, it's going to affect the value of the currency, and so it's going to affect the value of the treasury, and we can watch that. And so I can see, okay, is that a significant factor in price today? Because if it's the currencies, when the currencies move, what you tend to see happen is it just ticks up, and you don't even necessarily see any volume holding it or anything. It just moves, and there's nothing they can do about it. And so you really want to be with those ones. Is it equity correlations, which can kind of, be a little weird and then all of a sudden just go. That sort of a thing. And that could give us, so if we can have a numerical way of expressing the correlations, then that could give us some clues as to what kind of action we should be expecting. And then we could adjust our strategy based off of that. So I want to do something where it's like, I want like an automated algorithm that switches between a range bound and a trending indicator based off of the correlations that it's seeing. I heard a story of a number of traders trading 3 clay blocks thinking they were the elephants in the room. Then someone came along and took them out 7 levels with 98,000 contracts. So my understanding is that a bank could be trading tens of thousands of contracts. And when you get into like those central banks and domestic funds, that they can easily trade hundreds of thousands of contracts. It's crazy. And you also have to consider that they give themselves some amount of margin. So they say, like, maybe they want to buy 10,000 contracts for someone, but they might use 15,000 contracts, to help keep it, to help give themselves a better price, essentially, to move price around and give themselves a better price. Like, that's the thing that it gets interesting, is like there's the level that we're at where if you're trading one contract, it can affect the market, but the impact is extremely small. But you got to keep that in mind. That's why a lot of people, when they move off of sim, they are affecting the market, and the market adjusts to it. Like, even just one contract, I know it sounds crazy, but they can totally do it. And then you kind of move up to that level where the market is reacting to what you're doing. You have to adjust the way that you're doing it because of that, right? Okay, so I don't understand this one right here, but it's going to give us an example. So paired data, the mean of the X values, the mean of, okay, so there's 1, 2, 4, 5, so 1 and 1. The deviation is that S of X is 1.83 and S of Y 2.85. The below table summarizes the other calculations needed for R, the sum of the products in the 2 rightmost columns is 2.98. So is that times that equals 1.272792057. Okay, so it is just ZX ZY. So double ZX ZY equals ZX times ZY. And then the sum of the products of the rightmost column is 2. Okay, so that's all of these together. 4 points. Since there are 4 total points and 4 minus 1 equals 3, why is that? Divide the sum from add the products from the last step together. I see. and then divide the sum from the previous step by n minus 1, where n is the total number of points of paired data. The result of all of this is the correlation coefficient R. Okay, so really what we need here is this right here is going to be primary x compare of 0, right? And then do we have a sum? Oops. Dot. Well, we're gonna have to do a for loop. I legit just realized that when you're born with your head coming out first, you wear your mom as a onesie for a quick second. Crazy A. Anyways, all of it did. That's great. Yeah, 5-6 with the micros are going to bring in a lot of new traders. Yeah, it's going to be that first, man. We got to be ready for that first day, because the first day that those micro contracts go is going to be crazy. I'm going to be interested to see how much, what the liquidity on the DOM people are showing before the e-mini opens. So I'm going to be sitting there with my one little contract flashing it. I don't know about everybody else. Oh, okay. So Elon Musky Gooch says, what are we programming out? So we trade every day. We do this every day. But today is Good Friday and the CME is closed. So we're programming an indicator. We're trying to program an indicator that will show us correlation. So yeah. So I think that here to do the correlation, we're going to have to do a little for loop here. I++. Because I don't think that there is a sum. Oh no, wait, there is a sum. Wait, well, hold on a second. Sum value current var shows the summation of the last n data points. Okay. So sum of primary x compare, comma, period, divided by period minus 1. And that is going to be our, what were we calling it? Correlation coefficient of 0 equals that big old thing. I think. I don't need these, right? Yeah, I don't need those. So let's get rid of them over here too. We don't need these two. Okay. Double. Okay. Let's try compiling it. Watching you write code is too much fun for me. Have a great weekend. Oh, it's not much. Have you ever looked into toxic flow? So you talking about like flow that is intentionally placed in there to trip up other traders or algorithms? Oh, we need this from 0. That's kind of funny that the sum is a... Calling on bar update method on bar 0 index was outside of the bounds of the array. What is it? Okay. Index was outside of the bars of the array. VPIN. I don't know. You're gonna have to give me a more detailed description here for me if you want to talk about it, because I'm not sure what you're talking about. Oh, from pin to vpin, an introduction to order flow toxicity. Science Direct. Okay. Have developed a new measure of order flow toxicity called volume synchronized probability of informed trading, or VPIN. Order flow toxicity makes reference to adverse selection risk but applied to the world of high frequency trading. We provide a detailed description of the VPIN estimation procedure, paying special attention to the main innovations introduced and the key variables of this novel tool. By using a sample of stocks listed on the Spanish market, we compare VPIN to PIN. Although VPIN metric is conceived for the high-frequency trading environment, our results suggest that certain VPIN specifications provide proxies for adverse selection risks similar to those obtained by the PIN model. Thus, we consider that the key variable in the VPIN procedure is the number of buckets used, and that VPIN can be a helpful device which is not exclusively applicable to the... Oh, that is... I thank you very much for... directing me to that. So I would probably have to buy this, wouldn't I? Yeah, get access. I don't know, maybe if through your institution. that would be worth buying. Where is the... Bum, bum, bum. Aww. There's probably other ways to find it. Okay, we'll look at that later. We only got like a few minutes left here. So which thing is it complaining about? Do we have debug mode on? Yeah. Okay. There are free papers out there on it. So what you're saying is that we could go in there and we could say when the order flow is not matched. It's basically they're saying when the order flow is not matching the price, it's toxic order flow. And you could make your trading decisions based off of what kind of order flow you're seeing that day. And if it's toxic order flow, then we have to use the range bound strategy essentially. What am I doing? Debug, attached process, NinjaTrader. Okay. Okay. So it's when we are trying to do the primary X compare. Okay. Values of 3. Oh, okay. I know what's wrong. Stop debugging. Okay. So what happened was we... Oh, no, wait, hold on. Primary X compare is values of 1. Ha ha ha. Okay. So there's only 2 series now. We need to change that. Gosh, dang it. Really? It's you still being like that, huh? Unrenderable values? Well, which... Okay, so now let's... Okay. Let's reattach. All right. And run that again. What's the best way to... So it doesn't create a exception when it does that. Can I put a break in here and conditions, conditional expression? What is it? It's current. What is it? Oh, I know there's a... All right, we have to do... Where's my... I think it's in the footprint chart. Yeah. Bar update. This is still messy. NinjaTrader 8 current bar. So something like that. Is it? Oh, it's just current bar. Okay. Just have to confirm, I guess. So it's going to be in here. Conditions. If current bar equals 5110. Okay. Let's see if that will. Super advanced debugging there, folks. Did it break? It did break. Oh no, it did. Did it? Let's try that again. Okay. Because it has to do that calculation every time, it might be a little slow. Okay. Smash the Bit has the links for me, so we'll just save those. Okay. So it's not, doesn't appear to me to be breaking. Like, what the heck? Calculation results in unrenderable. Oops. Wrong place. Okay, so it's definitely that. Story time with Seth. Read the whole thing here on stream. Oh, it says it's not a number every time? What? That's not, it's not right, guys. It's still not right. It should never be over 1. Right. I don't think we have enough time to do that. It's gotta go in like 15 minutes. I would really like to fix this. But why is it giving us not a number? And that it. How do I say if it's not a number? Oh, cool. If correlation coefficient of 0 if double dot is non, this print meep. Okay. Yes. Okay. So now I can put a breakpoint in there. Bada boom. Okay. Period is 20. There's 511 things in there. Oh. Yes, let's do that. What happens if that sum is 0? Then you're doing 0 divided by 20 is not a number. Other calculations. So the ZX is the XI minus the mean divided by the deviation, then multiply the corresponding values and add all of these together. Okay, so let's split this up a little bit. I always make that mistake. I'm always like, we have to, in order to get back into NinjaTrader, we have to continue. Get rid of the breakpoint, continue. Cool. All right, so let's split this part up. Okay. Where's our chart again? Oh, we don't need that one. That one will move you back over here. Okay. This one, F5. Okay. Sums is not a number. What? ZX is not a number? Okay, so that would explain. So it's further back than that. Okay. Deviation primary is 0. Why is the standard deviation of my primary data series 0? So it gives me a bars array, right? Bars array of 0. So it's totally, that's totally right. Well, what is current bars? Or what is current bar? $26. What am I missing, guys? Well, I don't think I'm missing something. There is something about this that we don't. Okay, let's look at the standard deviation. Standard deviation, statistical measure of, rather than, for example, series of doubles over a given period. And it's 0. How is that possible? I'm super confused as to how. Input period bars. That's what we're doing right there. Bars ago. 0 bars ago. Calculate on bar close. Do I need to not use big case D's? I don't think that will make a difference, but let's try it. Okay. So it's still doing it. Still saying that my standard deviation is not a number. That could, I suppose that could be happening if like the first couple of bars it's just straight, but still. Hmm. Let's try that. Okay. Basically, it draws it for a little bit and then it stops. What is what is that? What is with that? Where have I done this before? Maybe I need to put the series up there. No, I know what we're gonna do. Standard deviation, 20 bar period. Okay. It is not. Oh wait a second. The standard deviation goes to 0 for a moment. Okay. So if the standard deviation of this is 0, well, that should be right then. It should be. Wait, what does it end up being? Um, uh, am I debugging? Oh, I'm not attached. That's why. Okay. So sums is not a number. zx is not a number. And zx is not a number because you can't divide by 0. So what do you do when... Hold on a second. What do you do when the standard deviation is 0? Yes, what do you do when the standard deviation is 0? Simplest interpretation correlation gives an indication of strength of the linear relationships. If standard deviation is equal to 0, the associated quantity is constant. So the notion of linear relationship between it and the other doesn't apply mathematically. In one of the standard deviations is 0, the correlation involves division by 0, so it is undefined. R equals 0. I think that you just say okay, we got only a little bit of time left. Gosh dang it. Oh, we need to continue. Okay. If deviation primary does not equal 0, let's just say double zx equals 0, double zy equals 0. And do it like that. If dev compare does not equal 0, and we need to get rid of those. Sure. Ba-ba-da-da. Well, it's still wrong because it's giving us numbers well past 2. So let's see here. If I come in here and I add the ES, ugh, why did I do that? Okay. Then they're going in opposite directions. And then this one's going flat and this one's going up. So all of a sudden, but when does these are going up? The correlation is going up. Dude, well, it kind of works. how can you get a correlation of -2? So there's something wrong in my calculations somewhere, but we're calculating what we want. So let's just take a look here one more time and make sure that we don't have any. Let's just see if there's any. It's true. If one of your standard deviations is 0, that equation is undefined. However, a better way to think of it is that if one of your standard deviations is 0, there is no correlation in loose conceptual terms. The only way that you get that standard deviation is 0 is if you have 20 minutes where it stays in one spot, which can only happen in Zn. And that was why we were having the problems that we have. Right? It totally works. But why does it go to -2? How does that work? Cannot be greater than the absolute value of 1 because it is a measure of a fit between two variables that are not affected by units of measurement. So the correlation coefficient is a measure of how well data points of a given set of data fit on a straight line. -1. Some of this math talk is making sense to me, and I like my brain. I can see when I read it, it's like my brain turns off. Calculate the mean of all of the first coordinates. Calculate the mean of all of the second coordinates. Calculate the standard deviation of all the first coordinates. Calculate the standard deviation of all of the second coordinates. Does it have something to do with my moving average? Like it's a moving correlation coefficient, and because of that, it's not working. Okay, well, anyways, Zx, let's see why I set those both to be 0. And then I say, if the deviation of the primary is not 0, then I take for each xi. Xi minus the average divided by the standard deviation. And then you multiply the values. You add the products from the last step together. Divide the sum from the previous step by n minus 1, where n is the total number of points in our set of paired data. The result of all this is the correlation coefficient R. How How about moving correlation coefficient? Well, this explains, like, what we're doing is technically the same thing as what we were doing before. It's just that we were getting the 0 in there further up where I didn't realize. So I could probably take it back, but maybe for this part doesn't matter. Let's just try that. I'm just randomly trying things now. Bum bum bum. That didn't change anything? I wonder. Let's just change this back to ZB. Okay. Well, it's definitely not working. I don't know what the deal is, guys. That method in this one doesn't seem to be correct to me either. I need to do a lot more investigation into see, this one seems like it should be. I probably need to do some of the adding, because one of the things that's happening is I'm taking the way that I'm calculating it. Oh man, to describe this is like hard, but like I'm creating this new value zx zy, but the best way to do it would be to like add the new one and remove the previous one. And Pearson's correlation coefficient. See, this one I think is, no, not this one. This one right here, what this guy is saying, I think is probably the simplest thing. Implement moving sums of x and x2 for both signals, then obtaining averages and variances as. Okay. The M equals the sum of x divided by the window length. The variance equals the sum of x's squared minus the sum of x squared divided by the window length. And then find the sum of all of these. And then the sliding correlation itself. So I kind of want to go back to the method where we're using the squares. Because I think the standard deviation thing is what is in there is maybe potentially screwing us up. And I kind of need to do something where it's like take the one that was the back and yeah. Running low on storage. Yeah. I need to I'm going to reinstall my machine this weekend. I got this thing right here. So I got a new drive. It'll make things a little bit faster too. Anyways, I don't know. I don't think we really accomplished what we want, but I hope that was useful for somebody out there seeing us debug it in real time and everything. Sorry that we couldn't get something usable though. So yeah, I guess I will see you guys next week. Have a good Easter weekend, and in the meantime, stay profitable, friends.